Why were Asian tiger economies vulnerable in the 1997 crisis? Imagine a region that's growing so fast it seems unstoppable. That's what happened to the Asian tiger economies like South Korea, Thailand, and Malaysia before 1997. They looked like success stories. But beneath the surface, problems were quietly building up. These economies attracted a lot of foreign money because investors saw quick profits. But many of these countries borrowed heavily from abroad, especially short-term loans that had to be paid back quickly. They invested this borrowed money into manufacturing and real estate, hoping to keep growing. However, this rapid expansion hid some serious issues. Many companies borrowed without enough regulation or oversight. They treated foreign and domestic debt as the same, even though international markets didn't always support such risky borrowing. Banks and businesses took big risks, encouraged by the belief that the government would step in if things went wrong. This created a moral hazard, meaning they felt safe taking risks because they expected bailouts. Another problem was the fixed or semi-fixed exchange rate systems these countries used, often pegged to the US dollar. This kept their currencies stable for a while but made them vulnerable to speculation. When investors started doubting the economy's strength, they began to withdraw their money quickly. This caused sharp currency devaluations, which made imports more expensive and stock markets tumble. Adding to the trouble was the lack of transparency and weak financial infrastructure. Governments didn't have enough tools or regulations to spot the risks early. They tried to attract short-term capital without safeguards, which increased the chances of a sudden crisis. When investor confidence dropped, capital flew out fast, and currencies collapsed. In the end, these economies were vulnerable because their rapid growth was built on shaky foundations. Excessive borrowing, weak regulation, risky banking practices, fixed exchange rates, and poor oversight created a fragile environment. When the global mood shifted in 1997, all these issues came to a head, leading to one of the most significant economic disruptions in recent history. Understanding why these economies were so exposed helps us see how important strong financial rules and cautious growth are. It's a reminder that quick success can hide deep vulnerabilities if not managed carefully. These lessons still matter today as countries navigate the tricky waters of global capital flows and economic stability.